You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie.
And I'm Miro.
Just a quick heads up before we start. We're just two friends chatting about markets, so none of this is financial advice. Just our personal takes. Don't go betting the farm based on our ramblings. Today, we are looking at Alaska Air Group. It is February 5th, 2026. And frankly, Miro, this report feels busy.
Busy is a polite word for it.
I was trying to be nice. But really, between the Hawaiian Airlines merger finally closing, a government shutdown in November, and seasonal winter messiness, I honestly expected a disaster, but they posted a profit.
Yeah, and not just a profit, a massive beat against expectations. So, headline numbers first. Alaska delivered adjusted earnings per share of 43 cents. Now, context matters here. Management had guided for something closer to 10 cents. So, optically, they smashed it.
Wow. That's not a rounding error. That's a real beat. What about the top line?
Revenue came in at $3.63 billion. That is down about 3.6% from the third quarter. But look, that's standard seasonality.
Mm-hmm.
People fly less in November than they do in August. The operating margin sat at 1.8%, which sounds razor thin because it is, but considering the integration costs and the chaos of the quarter, staying in the black is actually the achievement here.
Right. It's like landing a plane in a crosswind. As long as you don't crash, everyone claps. So how did the market handle this? Because I saw some wild movement on the chart.
It was a classic sell the news, buy the explanation kind of day. So the report dropped yesterday, and the stock initially drifted down about 1%. People saw the revenue dip and got nervous. But then, the earnings call happened this morning. Around 11:30 Eastern, management started talking, and the stock just ripped higher. It staged a complete reversal intraday, surging over 6% to close just under $51.
6% intraday swing? That is a lot of volatility for an airline. What did they say on the call that made everyone suddenly forgive the revenue dip?
Two things. First, corporate travel is back from the dead. They said managed corporate revenues rose 9% in the quarter, but, and here's the kicker, bookings for Q1 2026 are up 20% year over year. That is a huge confidence signal.
That's massive. That's the road warriors getting back on planes. And I assume the premium cabin story is still intact.
Oh, definitely. First and premium class revenues were up 7.1%. So while the folks in the back of the bus are price sensitive, the front of the plane is basically sold out. That mix shift is saving their yield.
The front of the bus pays for the gas, right? It's interesting, though. You have this government shutdown in November that cost them, about $30 million?
Yeah, about 15 cents of EPS. If that shutdown hadn't happened, their beat would have been even cleaner. It just shows how sensitive these networks are to external shocks.
And yet they still navigated through it. Okay, so we have a beat on profit, a chart that looks like a check mark, and premium travelers spending money. But I feel like we're glossing over the Hawaiian elephant in the room.
The very large island-themed elephant? Yeah, we need to talk about what's happening under the hood with that integration. Because the headline profit is hiding some, let's call them mechanics of the merger.
Mechanics, huh? All right, let's get into the details.
While mechanics might be generous, let's call it engine tuning. Because while everyone was cheering the EPS beat, I was looking at how they plan to measure costs next year. And Susie, they're moving the goalposts a little bit.
Oh, no. Whenever you use that metaphor, it usually means a footnote I ignored. What did they change?
Okay, so in the airline world, the holy grail metric is CASMs, cost per available seat mile excluding fuel. It tells you how efficient you are at actually running the machine. But starting in 2026, Alaska is changing the definition. They are removing performance-based pay from the calculation.
Wait, so if they pay their employees bonuses for doing a good job, That doesn't count as a cost of flying the plane anymore?
Not in the headline metric, apparently. Look, practically, it makes the unit cost look lower next to historicals. It smooths out the volatility. If you have a great year and pay huge bonuses, your unit costs won't spike as much visually. It's clever. It's not illegal, obviously, but it does make year-over-year comparisons a headache for people like me.
It's like dieting, but deciding that weekend calories don't count.
Exactly. And frankly, they might need that optical help because the actual integration bill is coming due. We saw total debt jump by about $550 million this quarter. Cash dipped by $150 million. They bought back a ton of stock, $570 million for the full year, which shows confidence, sure, but they're levering up to do it while digesting Hawaiian.
Right, and that's the scary part of mergers. The wedding is fun, the marriage is expensive. But surely the Atmos rollout helps. I saw a stat that loyalty revenue was up 12%. That's not nothing.
It is definitely not nothing. In fact, that is the lifeboat. The new loyalty program, Atmos Rewards, drove a record for credit card acquisitions in Q4. And this is the fascinating data point. Nearly 25% of those new signups were for the premium high-fee card.
That makes sense. If you're a Seattle or Honolulu traveler, you're locked in. You pay the fee, you get the miles. It basically turns the airline into a bank that occasionally flies jets to Hawaii.
That's cynically accurate, but it's crucial because the core business, flying metal tubes through the air, is incredibly fragile right now. Andrew Dodora actually flagged this on the call. He said, and I'm quoting here, every 10-cent change for the full year in fuel price translates to 75 cents of earnings per share.
Whoa! Wait, hold on. 75 cents of EPS for a 10-cent swing in gas prices?
Correct.
Their entire earnings beat this quarter was what, 43 cents?
Precisely.
So a slight twitch in the oil market wipes out the entire quarterly profit?
Welcome to the airline industry. It's a high wire act. That is why the credit card income matters so much. Bank remuneration is stable. Refining margins on the West Coast are not. So they are betting that the loyal premium customer with the expensive credit card will buffer them against, well, everything else.
It feels like a race, doesn't it? Can they integrate Hawaiian and get those synergies flowing before the debt load or fuel prices catch up to them?
That is the billion-dollar question. And speaking of billion-dollar questions, let's not forget the CapEx. They are projecting $1.4 to $1.5 billion in capital expenditures for 2026. They're buying 737-10s. They're buying 787s. That is a lot of cash going out the door when you're already projecting a loss for Q1.
Right. It's the spend money to make money phase, but the spending is very real.
It is. They are building a massive Pacific network, but right now, the scaffolding is costing them a fortune.
So high stakes, high debt, but very high loyalty engagement. So where does that leave us looking forward?
It leaves us in a classic jam tomorrow scenario. Management is calling 2026 the year of the harvest. They're basically saying, look, we spent the money, we merged the airlines, and now the profit machine turns on.
So, year of the harvest sounds lovely, but usually you have to get through winter first, and looking at their guidance, winter is going to be expensive.
It is. They are projecting a loss for the first quarter, somewhere between 50 cents and $1.50 per share. That is largely seasonal, and some of it is just the cost of combining two massive labor forces, but it means they start 2026 in a hole.
Right. So to hit their full year target, which is pretty wide, by the way, $3.50 to $6.50 per share, they need to sprint through the summer.
Exactly. And that spread, $3 of difference in the guidance, tells you everything about the uncertainty. They are betting heavily that those corporate road warriors booking up 20% in Q1 are going to stick around all year. If that demand softens or if oil spikes, that harvest rots pretty quickly.
It's a tightrope. But you know, If they pull it off, if they actually integrate this smoothly and hit that $10 EPS target they're promising for 2027, they aren't just a regional player anymore. They're a legitimate global competitor.
That is the bull case. They are trying to trade a utility valuation for a premium valuation. It's ambitious. Honest opinion, I think the strategy is right, but the execution risk is higher than the market thinks.
Well, at least they have the premium snacks to comfort us while we wait.
Speak for yourself. I fly economy.
Of course you do. Saving the margin one ticket at a time. All right. If you're still listening, hopefully that helps you make sense of the turbulence.
Thanks for sticking with us. We'll see you next quarter.
And just before we sign off, I want to pull back the curtain for a second. Earnings Unscripted is an experiment by a small team of enthusiastic people exploring the absolute frontier of generative AI, and specifically how it can be used to enrich our understanding of the world. To be totally transparent, this entire episode was created by a coordinated team of AI agents, from the research analyst who read the earnings report, to the scriptwriter who drafted our dialogue, to the QA specialist who checked the facts, and yes, even the voices of Miro and myself. We are all artificial agents working together to deliver high-quality, up-to-date information that would hardly be possible otherwise. We think there is something special about how humans and machines can tell stories together. But it is an experiment, and we really want to know what you think. So, if you have questions, comments, or feedback, please reach out at earningsunscripted@datamadness.ca or follow us on X.
It is a brave new world.
It is. Thanks for being part of the experiment.
Yes, see you after the next call.